This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to look at the chapter on variance analysis. And I did introduce variance analysis in the last chapter. So in this set of lectures, we'll have a quick bit of revision of the last chapter, remind you what variances are, but then I'll show you how they can expect a fair bit more work on the variances. And I'll show you all the things they could need. Now, it looks a very short chapter, there are only 2 pages, but in fact, within that, there's quite a lot we need to do. So I will break this down again into several lectures. But the first one is effectively a bit of revision of what we did in the last chapter, because it is important that you are clear what's happening to make sense of what comes later. So, can you look at example 1 with me? A company's prepared the following standard cost card, so there are budgeted costs, and we're budgeting on a cost of $53 a unit. And note that we're using marginal costing. We've only there got the variable costs, we've not absorbed any fixed costs. They've told us what the budgeted fixed costs are, 130,500. They've told us the budgeted selling price. And we're told the budgeted production and the budgeted sales. And note that we were budgeting on producing 8,700 and only selling 8,000. And so we must be expecting closing inventory of the extra 700 units. Below, we're told what actually happened. We sold 8,400 and got 613,200 revenue. We produced 8,900 and there are all the actual costs. And if you remember, the basic purpose of this is controlling, to be able to compare what actually happened with what should have happened. And again, although I shouldn't need to go on about this because I talked about it in the last lecture, to compare the actual with the original fixed budget would be silly. We produce more units, we expect to spend more. And so we need to flex our budget for the actual level of activity, and then we can compare. Well, this is a bit of revision, so let's do the whole thing, just like I did in the lectures on the last chapter. I'm going to write up the original fixed budget. I'm then going to flex the budget for the actual level of activity, and we'll compare that with what actually happened to calculate the variances. So let's make a start. First of all, then I don't lose track of units. For the original fixed budget, we budgeted on selling 8,000 units and of producing 8,700. I'll deal with the others when I come to them. And so let's run down the original fixed budget. First of all, the revenue. It says the budgeted selling price was $75 a unit. So with sales of 8,000, we budgeted on total revenue of 600. We need to know the cost of sales. But to get the cost of the 8,000 sold, we'll take the cost of what we produced less any closing inventory. So the cost of production $8,700 units. Well, first of all, materials. From the cost card, we should be spending $18 a unit. So with 8,700 units produced, we'd be budgeting on 156,600. Labour from the cost card should be $25 a unit. So again, without 8,700 produced, it should be 217,500. And variable overheads. The cost card, $10 a unit. 8,700 at 10, 87,000. We're using marginal costing, so for the moment we'll stop there. We'll only look at the marginal, the variable costs. And so the marginal cost of production, 156,600, 217,500, 87,000. A total of 461,100. Now that's the cost of the 8,700 produced. To get the cost of the 8,000 sold, subtract the closing inventory, the 700 units that are left. They're valued at standard cost of 53. 700 at 53 is 37,100, giving a cost of sales 461,100 minus 37,100, 424,000. And so revenue 600, cost of sales 424. That gives us a budgeted contribution. 600 minus 424, 176,000. And that, remember, the contribution, the profit before any fixed costs. And so finally, to get the profit, let's subtract the budgeted fixed overheads. They're budgeted at 130,500, which finally gives us an original budget profit of 45,500. So nothing new really from what we did in the last chapter. And don't worry, you won't be expected to do all of this in the exam. Not for 2 marks or whatever. But it is vitally clear what's happening to make sense of what comes later. Do note as well, before we carry on, that in fact the contribution, I could have written that straight down. That the contribution, we know how many we were selling. We were budgeting on 8,000 units. The standard, the budgeted contribution per unit, well, we were selling at 75. Standard cost 53. So a contribution of $22 a unit. 8,000 units at $22 is 176,000. Anyway, that's the original budget, but to make sense of the comparison, to be able to compare actual with budget, we need to flex the budget, to rewrite the budget based on the actual activity, and the actual production was 8,900 units. The actual sales were 8,400. So still using budget figures, standard costs, let's write down what should have happened. The revenue at 75 a unit, and I've written them upside down, I do apologise. The sales, the actual sales were 8,400, production 8,900, sorry. So the revenue, 8,400 sold at 75. The revenue should be 630,000. The cost of production, well, 8,900 produced for materials at 18 a unit, should be 160,200. Labour, 8,900 produced at 25 a unit, 222,500. And variable overheads, 8,900 produced again at $10 a unit, should be 89,000. And so if everything went perfectly, the cost of production should be 160,200, 222,500, 89,000. 471,700. However, again, that's the standard cost of the 8,900 produced. We only actually sold 8,400. So there's closing inventory of 500 units. 89 minus 84. Valued at standard cost of 53. 500 at 53. 26,500. Giving a cost for the 8,400 sold of £445,200. And therefore a contribution, 630,000 revenue, 445,200, cost of sales, 184,800. Fixed overheads, of course, should have stayed the same. Fixed overheads shouldn't change with the level of production, so should still be 130,500. Giving a flexed budgeted profit of 184,800 minus 130,500, 54,300. And again, appreciate before I go any further that the contribution, although I wanted to do the full statement here again to make sense of what's coming later, but I could actually have written the total contribution straight down, in that we sold how many? 8,400 units. The contribution for each unit should be 75 selling, 53 cost, so $22. 8,400 at $22 a unit is 184,800. However, we're virtually there. Why have we done that? Why have we flexed the budget? It's so that we can now compare what actually happened with what should have happened. So, of course, the actual sales were 8.4. The actual production was 8.9. But what were the actual figures? Back to the question. The actual revenue was 613,200. Cost of materials was 163,455. Labour 224,515. Variable 87,348. And so the marginal variable cost of sales was actually $475,318. That's the cost of production. To get the cost of sales, again, subtract the closing inventory. And again, it's 500 units. We produced 8.9, sold 8.4. So 500 units at standard cost of 53, 26.5. Now, certainly some of you might worry there for a minute. I'll come back to that. But 500 units in inventory, I value them at standard cost of 53, gives me a cost of sales of $448,818, and therefore the actual contribution 613,200 minus 448,818, 164,382. So there's the actual contribution. To get the profit, subtract the actual fixed overheads, which are 134,074. And we get an actual contribution of $33.08. Now, just one thing before I finish this off. Some people get very upset about the way I've valued the closing inventory. Clearly, there actually were 500 units, and I valued them at standard cost. But of course, the actual cost is different. You know, the materials, labour, variable. We didn't pay standard costs. We didn't pay 18, 25, and 10. And so some people say, the cost wasn't 53 a unit. We should value inventory differently. Well, for financial accounts, we would. However, for management accounts, certainly for variance analysis, regardless of what we actually spent, we still value the inventory at standard cost. Now, I'll tell you why, but I mean, a rule's a rule as far as the exam's concerned. The reason is that this exercise is usually done monthly. Obviously, some months you might spend a bit more than you expect. Some months you might spend a bit less. Well, we're not going to keep changing the value of inventories every month. This month we spent more, so they're higher. Next month we spent less, so they're lower. Standardly, we'll keep inventory valued at the standard cost, what we hope will be what you might call the average for the year. Finally, though, why again have we done this? Well, we can now compare actual with flex budget and see where have we overspent or where have we saved money. And so let's look at the differences or the variances. Revenue. We should have had 630, we've only got 613,200. We've lost 16,800, the difference. And I did say in the last lecture, rather than put pluses and minuses, if the difference is giving us extra profit, we put F for favourable. On the other hand, if we're losing, we put A for adverse. And here, surely, it's adverse. We've got less revenue than we should have. On its own, that would mean less profit. Materials. We spent 163,455. It should have been 160,200. We've overspent by 3,255. And if we've overspent, surely we spent too much. That means, again, less profit. Labour. Again, we've overspent 224,515 as against 222,500. 2015 adverse. If you spend more, less profit. Variable overheads. Here we've done well. We expected to spend 89,000. We've only spent 87,348. We've saved money. Certainly not that figure. Let me do it again. 89,000 minus 87,348. Yeah, we've saved 1652. We save money. That would give us more profit. It's favourable. And finally, what about the fixed overheads? We should have spent 130,500. We've spent 134,074. We've overspent by the difference of 3,574. It's adverse. And so just as a little check on ourselves, the net of the variances should explain the difference between actual profit and flexed profit. So let me just check. 16,800 adverse, 3,255 adverse, 2,015 adverse, minus 1,652 favourable, 3,574 adverse. Error. 16,800, 3,255, 2,015, 652, 3,574. I get 23,992 adverse. That doesn't actually mean anything, except as a check on myself, that should be the difference between the flexed and the actual profits. So let me make sure. Yeah, 23,992. And so there we are. Again, that was just a slightly longer version of what we did in the last chapter, so nothing new there. I remember what the purpose is. You see, management were expecting 45,500. They'll want to know why the actual figure was so much different. What went wrong? Well, of course, the most obvious reason for the profit being different is we sold more units. We sold, what was it, 8,400 units when we expected to sell 8,000. And so, surely management are going to expect as a result there'll be higher profit than 54,300. And in fact, that extra, if everything else went perfectly, 54,300 minus 45,500, we'd have had an extra 8,800. And I could have written that straight down, because surely, imagine you're the manager. You're expecting $22 a unit contribution. We sold 400 more units. And 400 more units, where is it? I'm trying to get the colour, there we are. 400 extra units at 75 minus 53 at $22. Fine, they expect 8,800. So why didn't we get 54,300? All these things here. The revenue. All right, we did sell 8,400, but we got less than we should have done. Think about it, we must have sold them at a lower price, and that cost us 16,800. We overspent on materials, we overspent on labour. Again, it's losing money, it made less profit. We saved a bit on variables, so things weren't quite as bad, but again, we overspent on fixed overheads. Now, ultimately, I will, at the end, produce a nice statement again, like we did last time, explaining to management why, although they thought the profit would be 45,500, they actually only made 30,000. However, I've said several times, what we've done there effectively is just revision, and you'll never be expected to write those statements up in full. But as I keep saying, it's vital you understand what's happening for what's coming, because although what's coming, to an extent you learn rules, it's pointless learning rules without basically understanding. Because I'll tell you what's coming. Look at materials for a minute. We know we overspent by 3,255. If you look at the cost card, we should have spent 18 a unit. We're obviously spending more than 18. However, there are two different reasons that could have happened. Because if you look at the cost card, each unit should have used 4 kilos of material, and each kilo of material should have cost $4.50. Now, we have ended up spending more than 18, but was it because we used more material than we should have done? You know, maybe we kept wasting material. Maybe we used 5 kilos a unit instead of 4. Or alternatively, is it because we paid more per kilo? We should have paid $4.50 a kilo. Maybe we paid $4.60. Now we need to find out, because it's likely to be two separate managers. You know, maybe the production manager is the person who should make sure we're using 4 kilos a unit. And if we use more, it's his fault. However, he doesn't actually buy the material. You know, maybe we've got another manager who does the buying. They should have paid $4.50 a kilo. And if they paid more, it's their fault. And so what we're going to do in the later lectures is look at each of these variances and analyse them. We're going to look at that materials one and say, okay, we overspent, but how much of that is because perhaps we paid too much a kilo? And separately, how much of that is perhaps because I used too many kilos. That's where the fun starts. We know in total how much we overspent on materials, labour, variable. We're going to go through, we're going to analyse. Why did we overspend? What were the reasons? So it is quite enjoyable, and I'm sorry spending all that time doing revision. But for the last time, you must understand what we said there to make sense of what's coming. You know, it's too dangerous simply to learn a few rules. So I'll pause this lecture here, but keep those workings. I can refer back to them. In the next lectures, we'll start analysing these variances.